All right, something just snapped in the silver market, and it's not what most people think. In less than a week, Western silver prices collapsed from around $121 an ounce down to roughly 85. That's a 37% wipeout, fast and violent. And while Western investors were dumping, new reports just hit that China stepped in and started buying billions in gold and silver. Both Western price feeds and Shanghai exchange data are confirming this split right now. If you're holding silver, if you're watching precious metals, or if you just want to understand how global markets really work when stress hits the system, stay with me, because I'm going to show you why this isn't a normal crash and how you can recognize this pattern before it shows up again. Now, before I explain what actually caused this, let me teach you something most people don't understand about precious metals. When you hear silver price, you assume there's one global price, right? There isn't. What you're usually looking at is a paper price driven by futures contracts, leverage, and margin rules. Physical silver is a different animal. Think of it like airline tickets versus actual seats on the plane. You can trade tickets all day long. You can sell the same ticket 10 times over, but that doesn't magically add or remove actual seats. When stress hits the system, when everyone wants their seat at the same time, paper prices can collapse even if real-world demand for actual seats never does. Here's what you need to know about silver specifically. It's one of the most heavily leveraged commodities on the planet. That means a small move against traders can force huge liquidations. So when volatility spikes, the paper market can unwind brutally, even if nothing changes in mines, refineries, or end-user demand. Keep that framework in your head, because it explains almost everything you're seeing right now. Paper doesn't always reflect physical reality, and in silver that gap can get massive. Let me give you another way to think about this. Imagine you're at an auction and someone's selling claims to 1,000 ounces of silver. But there's only 100 ounces in the vault. As long as everyone's happy, holding paper claims the system works, but the second people start demanding delivery, start asking for the actual metal, the whole thing breaks. That's the tension we're watching unfold. And if this is making sense so far, drop a comment below. I want to know if you've been tracking this or if this is new information for you. So what does that tell us? And it tells us that when you see a price crash in silver, your first question shouldn't be, is demand dead? Your first question should be, is this a paper market event or a physical market event? Because the answers are completely different, and the opportunities are completely different. Now here's what's actually happening. Let me break down the sequence because the order matters. The initial trigger wasn't China, and it wasn't some sudden surplus of metal flooding the market. It was forced deleveraging in Western paper markets. Prices dipped, margin calls hit, and leveraged players had to sell whatever they could as fast as they could. That selling pushed prices lower, which triggered more margin calls. You know the drill. It's a cascade, a liquidation spiral. Here's how it works mechanically. Let's say you're a hedge fund and you're long silver futures with leverage. You put up 10% margin to control a position. Silver drops 5%. You're now down 50% on your capital. Your broker calls. You need to post more cash or they'll close your position, but you don't have cash sitting around. You're leveraged everywhere. So you sell silver, you sell gold, you sell whatever's liquid. And when you sell, prices drop more, which triggers more margin calls, which forces more selling. That's the primary driver. Forced liquidation, not a change in supply, not a collapse in demand, just leverage unwinding. And when leverage unwinds, it doesn't care about fundamentals. It only cares about raising cash right now. But here's the part that should make you nervous if you're not watching closely. While Western spot silver was getting crushed down near 85, Shanghai silver barely flinched. It's still trading around $122 an ounce. That's a 40+% premium. Let that sink in for a second. If physical demand had actually collapsed, If the world suddenly didn't want silver anymore, you wouldn't see that kind of spread. You'd see prices converge. Global markets would equalize. Instead, they diverged violently. So what's happening in Shanghai? Physical buyers are still showing up. Industrial users still need silver for electronics, for solar panels, for batteries. Sovereign buyers still want hard assets, and they're willing to pay $122 while Western paper traders are panic selling at 85. That's not a normal market, that's a dislocation, and dislocations don't last forever. Here's the secondary confirmation that validates this whole thesis. While Western funds were dumping, China reportedly stepped in with billions in purchases. Now, we can't confirm every transaction in real time, but multiple reports, both from commodity desks and exchange data, are showing significant accumulation. Why would China buy aggressively during a crash? Because they understand the difference between paper panic and physical value. They've done this before. They wait for Western paper markets to break, then they convert paper panic into physical accumulation. And here's where it all comes together. When forced selling hits paper markets and physical markets hold firm, you're watching a textbook divergence play. The paper market is screaming, "Get me out." The physical market is saying, "I'm not going anywhere." And sovereign buyers are stepping in to bridge that gap. They're taking metal off the market while prices are depressed. That's the convergence proof. That's why this crash was mechanical, not fundamental. Now let me show you what very few people are talking about. This tells you the sell-off was structurally driven, not emotionally driven, and mechanical moves can reverse just as fast once the selling exhausts. Because here's the thing, if you sold everything you had to sell, if all the margin calls are done, if all the leverage positions are closed, who's left to sell? Nobody. And if physical demand never actually broke, if China's still buying, if industrial users still need the metal, what happens next? Prices stabilized, then they recover. Now let me zoom you out, because this isn't speculation, this is pattern recognition. This is the exact same playbook we saw in 2008 and again in 2020. Let me walk you through both. In 2008, when Lehman Brothers collapsed and the financial system froze, what happened to gold and silver? They got slammed. Gold dropped from over $1,000 to under $700. Silver fell from $21 to under $9. Why? Because funds needed liquidity. They sold anything they could sell. But what happened after the forced selling stopped? Eastern central banks stepped in. China bought, Russia bought, India bought. And within 18 months, gold was back above 1,000 and silver was climbing toward 50. Same pattern we're seeing today. Paper markets broke. Physical buyers accumulated. Recovery followed. In 2020, during the COVID crash in March, silver fell from $18 to under $12 in 2 weeks. 33% drop. Sound familiar? Funds were liquidating everything, margin calls everywhere. But what happened? By August, silver hit $29, more than doubled in 5 months. Why? Because the forced selling ended, physical demand stayed intact and the bounce was violent. Every time this pattern appears, the key signal isn't the initial crash, it's the premium divergence. It's physical markets holding firm while paper markets collapse. It's accumulation happening while sentiment is still broken. And that's exactly what we're seeing right now, with Shanghai trading 40% above Western spot. Here's the larger context. Silver's been in a structural bull market since late 2022. It went from under $20 to over $120 in roughly 2 years. That's a 600% move. Along the way, there were corrections, there were shakeouts, but every time forced selling ended and real demand stayed intact, silver didn't just drift higher, it snapped back. Volatility stayed elevated, but rebounds tended to be sharp because there was no real oversupply to cap the move. So when you look at the pattern, when you study what happened in 2008, in 2020, and what's happening now, the lesson is clear. Liquidity crises create mechanical sell-offs in leveraged markets. Those sell-offs don't reflect fundamental demand, and when the selling exhausts, recovery can be fast and violent. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this stay ugly for longer? Absolutely. Paper markets can overshoot. Liquidity stress can linger for weeks or even months. And yes, China buying doesn't guarantee an immediate bounce. Markets don't turn on a dime just because smart money shows up. Could this be manipulation? Could Western banks be shorting silver into the ground to suppress prices? Maybe. People have been making that claim for years. Here's the thing, though. It doesn't actually matter whether there's intent to manipulate or whether this is just market mechanics playing out. The mechanics are what matter. Focus on what you can control. Focus on what you can observe, watch spreads, watch premiums, watch where forced selling ends and accumulation begins. That's actionable. Conspiracy narratives aren't. Could fundamentals shift? Could industrial demand weaken? Could a recession hit and slow silver consumption? Yes, that's always a risk. But right now, we're not seeing evidence of that. Shanghai's still paying premium prices. Physical dealers aren't reporting inventory buildups. The fundamental story hasn't changed. What changed was leverage and liquidity in paper markets. So I'm not sitting here telling you this is a guaranteed bounce or a sure thing. I'm telling you what the data shows. I'm telling you what the pattern looks like. And I'm telling you to think critically about whether this is a fundamental shift or a mechanical event. There are probably three types of people watching this right now. Let me speak to each of you directly. The first is panicking. You saw silver crash 37% in a week. You feel sick. You're wondering if this is the start of something worse. Maybe you bought near the top. Maybe you're down hard. Maybe you're thinking about selling just to stop the pain. If that's you, slow down. Take a breath. Ask yourself one question. Did anything fundamental change, or did you just watch a leverage unwind? Did mines stop producing? Did solar panel manufacturers stop using silver? Did China stop buying? Or did Western hedge funds get margin called and dump everything? There's a big difference. Your job isn't to panic. Your job is to understand what kind of event you're watching. And if you can't tell the difference, then you probably shouldn't be in leverage positions in the first place. The second type is skeptical. You think this sounds too neat, too clean. You think I'm cherry-picking data or ignoring risks. Fair. Your job is to wait for confirmation. Don't chase. Let price stabilize. Watch for follow-through. If Shanghai premium narrows, that's a warning sign. If Western spot breaks below 80, that changes the picture. But if premium holds and price stabilizes, you'll have your confirmation. Just don't wait so long that you miss the move entirely. There's a balance between being patient and being paralyzed. The third type is strategic. You're calm, you're patient, and you're watching signals, not headlines. You already understand the difference between paper and physical. You've been through drawdowns before. For you, this is about preparation, not prediction. You're watching where support forms. You're watching accumulation signals. You're thinking in probabilities, not certainties. And honestly, if that's you, you're already ahead of 90% of people watching markets right now. But here's the universal rule for all three types. Don't confuse paper stress with physical reality. Don't assume a futures market liquidation means the end of a bull market. And don't let short-term volatility shake you out of a position you took for long-term reasons. That's how retail loses money. They buy high on emotion and sell low on fear. So here's what I want you to answer in the comments. Which type are you? Are you panicking, skeptical, or strategic? And based on what you've learned in this video, how are you approaching this situation differently now? Now let me tell you where I stand. I'm not euphoric, and I'm not bearish. I'm focused. Let me tell you what I'm personally watching. First, I'm watching whether Western silver holds that $80 to $85 zone. That's the battlefield right now. If it breaks below 80 and stays there, that would indicate more forced selling or a fundamental shift I'm not seeing yet. But if it holds and starts building a base, that's your first signal that the worst is over. Second, I'm watching Shanghai. As long as it stays above roughly 115, physical demand is sending a clear message. It's saying, we don't care what paper markets are doing, we want the metal. But if that premium starts collapsing, if Shanghai drops toward Western levels, that tells me physical demand is weakening. That changes everything. Third, I'm monitoring the premium itself. Right now, it's north of 40%. If it stays above 25%, a near-term recovery stays firmly on the table. If it narrows below 20, I'd start questioning whether accumulation is real or whether this is just noise. Based on my analysis, this crash was structural and mechanical, not emotional and not fundamental. The fundamental picture hasn't changed. Physical demand is still there. Industrial use is still there. Sovereign buying is still there. What happened was a forced deleveraging event in paper markets. That's it. If history rhymes and silver stabilizes in this zone, the move that follows could be sharp, not because I'm predicting it, but because that's what happens when forced selling exhausts and real demand stays intact. The snapback tends to be violent because there's no overhang of supply keeping a lid on price. Now, I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check Shanghai prices yourself. Look at premium data. Don't take my word for anything. Your money, your decision. But if you made it this far, you're someone who thinks critically about markets. You're someone who wants to understand how things actually work instead of just reacting to headlines. That mentality will serve you well, not just in silver, in every market you touch. If this breakdown helped you see the situation more clearly, share this video with someone who needs to hear it. Subscribe if you want more real-time analysis when markets move, and stay ahead of the noise by learning to read patterns instead of chasing price. Think critically, verify the data, and make your own decisions. Stay sharp out there.